Welcome back to another episode of the Educated Homebuyer Live. We are here to answer your mortgage, real estate questions, have some fun along the way. Once again, we have Mr. Josh Lewis, my certified mortgage, mine. I own you, Josh. Who I use for loans, my clients use for loans, here helping us once again answer mortgage questions. So Josh, welcome back.
Just happy to be here, Jeb. We've made it another week. We're alive. Every day above ground is a good one. Just excited. Another Fed meeting. It's like Groundhog Day. Like every 5 weeks or so, we
like Groundhog Day. Every week we do this. So big news today is the Fed came out and hiked the Fed funds rate 0.25%, but then hinted at a pause. With that, we actually saw the 10-year close near the lows of the day, sitting really close to the lowest level we've seen in quite some time, Josh. But we talked last week. The real news is CPI next Wednesday. So this week, next week are really going to be two big weeks for the market with regards to how this data impacts mortgage rates, which ultimately impacts housing prices, demand, inventory, all of those things. So, the title of this video is The Biggest Problem in the Housing Market. Well, the biggest problem in the housing market is inventory, and inventory has been constrained a lot to do because of rates, right? Because of what the Fed did last year, what the Fed has done since then in hiking rates, locking people under their homes. But Josh, not under their homes, into their homes. Depends on where you're located. Maybe, you might be in your basement locked in. I'm not sure. But nevertheless, Josh, where should we start today?
The Fed is interesting. We've got some boring charts in here. You got boring real estate charts, and then I've got boring banking charts and fun stuff along those lines. Why don't we actually jump into the charts unless you wanted to do some chit chat first?
No, let's take a look. We always start with inventory. Again, the biggest problem in the housing market, in my opinion, is inventory. Housing affordability is a problem. Housing affordability could work itself out if there was more inventory, right? And obviously it's not that simple, but inventory has increased 2% since last week. So this is really the first significant, and I say significant increase. We went from 410,000 homes nationwide to 422. So not really that significant, but 2% jump, which is the highest level we've seen in the last couple of weeks in doing this. Orange County inventory sitting pretty close to where it was last week, 2,054 homes. Huntington Beach sitting at 144. Again, hasn't really changed very much. So even though we saw those increases nationwide, locally here, California, still not seeing inventory really pick up. And that's because new listings still have not, we're seeing new listings pick up, but not at a pace any higher than where we were last year, which is resulting in fewer homes for buyers to choose from, multiple offers on those properties when you go to make an offer. And if you're out there in an area and you're not seeing this, you're making offers and you're not multiple offers and you're not having to do above the asking price and all of that, that is opposite of what we're experiencing here in Southern California. In fact, I've put in the last 2 weeks, no less than 10 offers. None of them have been accepted for buyers. And these are strong offers, money down. These aren't like, somebody trying to get a deal on a property, which I think is really, really important to note. Inventory historically going back, prior to 2016, kind of see that down leg. You're kind of seeing it turn a little bit there towards the end of this chart. Does that, is that a leg up? Hard to say at this point. I do think inventory is going to increase some. I'm not sure if it's going to be enough to pass the recent high that we saw back towards the end of last year. That's really the question that we're all asking ourselves at this point. So new listings coming to the market, 85,000 right, this past week compared to 99,000 this week last year. So less than where we were, 16% less than where we were this time last year. Total homes, active listings versus homes under contract, again, sitting somewhere around 422,000 homes. That pink box is the light pink behind it is showing inventory where it is today. The darker red box is homes that are, what is it? Active listings. I got this chart confused here. So which one is this? This is active listings versus homes under contract. So the dark pink are homes under contract. So both inching upward. Median price of home, again, kind of moving sideways a little bit, not really seeing a big increase, not really seeing a big decrease, which out there, depending on your market, we've seen prices go up. I don't know that they're definitely not above the highs that we saw last year for most properties, but they're also not going lower. It's kind of weird, Josh, when you look at the market, knowing that things have calmed down, but at the same time, knowing that things really haven't calmed down at all.
I always have a hard time with charts like this. A couple things we've talked about. Median sucks. Median sucks on the way up. It sucks on the way down. It's never a real accurate figure, and it's a little bit more volatile because it's not actually telling you the price of the same homes selling over and over again.
Yep.
It's telling you the market mix. So when more expensive homes are selling, it makes the median look like it's higher when those homes didn't go up that much. It's just the median moved up, and vice versa. When people are buying more affordable homes, it makes it look like prices went down when it's just the volume sort of move to a different part of the market. And on top of that, this is United States. All I can say is anecdotally, like we're going to go through some charts. We had CoreLogic came out with their numbers this week, and we'll look at that chart and you see, and they have the entire West Coast is sort of their blue, which is kind of their cool market. And I can tell you, I only do loans on the West Coast. We're licensed, in Washington, Oregon, Arizona, Texas, Colorado, and all of those areas, I don't have anyone going, hey, you know what? I just walk out and I name my price. They're all saying, hey, this is brutal for decent houses. There's multiple offers. So it's not surprising to me that it's going up. It wasn't surprising that it was going down just because we have so few qualified buyers who can and will pay current prices.
No, absolutely. And because of that, housing demand continues to be strong. Therefore, price reductions aren't, sellers aren't having to do as many price reductions in this market because of that demand. In fact, we just passed 2019. So in 2019, this time of year, we had more price reductions in 2019 in May this week than we do today. So just a little bit of context there. Doesn't mean that home prices are done going down. Doesn't mean they're up from here. Doesn't mean that at all. It's just, providing you a little bit of historical context. Josh, this is a little bit early in our slide here. Did you want to talk about this right now? Because I know there's another chart that pertains to this as well.
I probably didn't get it moved to the right spot. Let's come back to it.
All right. So here, a little smaller chart, but this basically just shows globally what other markets are doing, where their policy rates are. Right here in the United States, it's the Fed funds rate. In other areas of the country, it's called something different, but essentially, it's where their monetary policy, the cost to borrow money,
So
overnight, banks lending to one another, all that good stuff. Yep.
Jeb, this is an interesting chart. The one where it just has the one pink box at the top,
Yep.
that is the central bank rate. That is the rate that the central bank in that country has set. Next to it, to the right, is year-over-year CPI. So then the column that has the pink and the light green there tells you real interest rates. You guys have probably heard this. People are still bitching and complaining. The Fed is not restrictive enough. We still have negative real interest rates. And why it was true until this morning, but now we've got CPI at like 5.1, and now we've got a 5.25 Fed funds rate.
Yep.
So we have a positive Fed funds rate that is lagging. Whether you think inflation is going to 2% or going to 3.5%, it is going much lower and very quick. So we're going to go from very loose, very accommodative to very tight and very restrictive really fast. And the people who've been complaining about Fed policy for the last 2-3 months, not the last year, because the Fed was way behind it. They had to step in, they had to get aggressive. But they could have paused. They could have paused and kind of given this time to work its way through. But we're going to see. They've finally got positive real interest rates, and we'll see what that does. And one of the future charts here will kind of go through and show what it's doing to the banking industry.
Yeah, and this is a chart I threw in, just shows that job openings are starting to decline. JOLTS numbers, right? So we're down now under 1 million job openings. We're seeing companies like Meta continue to lay off employees. Just showing signs that credit tightening out there, slowing economy, all of the things that we talk about that's likely going to put us, in a recession at some point, either latter this year or first half of 2024. So this is CoreLogic, right? Kayshilla?
Yep. CoreLogic, they do their monthly report. Again, we've like to point out that during the pandemic, they were horrifically wrong, saying that home values were going to drop when they were going to the moon. Now they are one of the few voices is saying year over year, they do expect positive real home price growth. So current, you can see month over month, 1.6% up. That was shocking. We had, I believe, even on CoreLogic, Jeb, we had one of these that was negative. So to have a 1.6 month over month, that's a big number. But 3.1% year over year, still it's distorted. Because for a number of reasons. So the forecast is kind of important here, or an important piece of that, in that they think 0.8% next month, which that's a big number. That's a 10% annual increase. But it's sort of the buying season. It's when we see most of the appreciation. So don't want to necessarily extrapolate that out to them saying it's going up 10%. In fact, they say over the next 12, they expect 4.6%. I think that's aggressive. I think it's possible, but that's like high end, best case scenario. What about yourself, Jeb?
No, I mean, again, we talked about it the other day. It largely has to do with interest rates, right? What happens with interest rates? What happens with inventory? You've got to see more homes come to the market. I don't know how we continue at the pace that we're at. What unlocks this inventory? That is really the question at hand. Affordability is clearly playing into it. The demand isn't as high as it seems. It's just there's no property to choose from, right? If you had double, triple the amount of inventory on the market wouldn't be doing what it's doing. It's doing that because there's still way too many people chasing way too few properties. And so for the foreseeable future, yeah, this looks reasonable just because inventory is so low. But the real question, again, is do we see an increase here in the next couple of months, weeks? If interest rates move lower, does that allow some people to unlock from their property? Yeah, that's the question. So,
and Jeb, here's my take.
Yep.
What I was going to say, you nailed it at the start. It's dependent upon interest rates. But here's the thing. If interest rates drop, it improves affordability. Does it mean we go from 26% affordability to 46%? No, it doesn't. But if we go from 26 to 32, that's a lot more buyers. Now, the interest rates dropping will also bring out more sellers who say, I'm comfortable with that increase in my interest rate where I may not be right now. So I don't see room for a drop in home prices because I think we'll see that supply demand balance. I also don't see room for a big increase as, yes, lower rates will bring demand, but it'll bring supply. I think we're going to kind of see this little stalemate. We're seeing in the comments here, people, they're like, it's tough out here. It's still, like, in terms of getting a property under contract, it is much better than it was in 2020 and 2021, but it is still brutal out there if you're trying to get one of the nice homes under contract. And I would expect that going forward. So this is just the chart that I was talking about. It shows the entire Western United States, 0 to 2% year over year change. And you look at the Southeast and even up in the Northeast. Who in the world wants to live up in those crazy cold states up in the Northeast, Jeb? Why would those be going up 7 to 10%? You would think people would be fleeing.
Because they only have 7 homes up there, and and there's 8 people that want to live there. So they are vying over the 7. Next chart, again, just another view of the same chart, or another,
And Jeb,
I don't even know what I'm saying.
Anecdotally, we've heard from people in Vegas seeing price cuts, so that makes sense. They'd be down 3. Denver down 1.9. I had a client in Denver. We're talking to him last week. He's at the $1 million price point. It's not like affordable entry level home, and he's like, "This is rough. Hard to get anything out here." Phoenix down 2%. You subscribe or you have access to the Cromford report, Jeb, and you look at it, and they're saying it's again, demand way down, supply way down. So most of them are not seeing that. People paying premiums for new construction so they don't have to go out and get into a bidding war on that. Now, San Diego, LA, same stuff. It's just, not necessarily seeing it with my clients. Not saying it's not happening. I know this is valid data and they're gathering it. It's hard to see where that is happening.
I agree. So this goes back. Let's see if we got what else. So let's talk about this real quick. We'll end on FHA and rates and all of that good stuff here in just a second. But so the Fed obviously had some changes in their monetary policy today in the announcement that they put out. What's redlined here has obviously been, taken from the report. The blue is obviously what's been added in. And the big things here is more or less that they left the door open for a rate hike. Rate hike. They left the door open for this to be the ceiling with regards to rates. That's really what we're boiling this whole thing down to. Something important to note here: the next 3 months, right? So we got April data gets replaced next week. April data last year we reported 0.4. May CPI was at 0.9. So in June, when we report that June number, that's a 0.9 coming off. And then in July, you got a 1.2 that gets reported in August. So over the next 3 months, you got 2.5% of that 5.1 that we're sitting at right now, Josh, or 5 what are we on the overall? 5
inflation?
Yeah.
Yeah, I think it's like 5.1.
Whatever it is. 2.5% is the next 3 months that's going to get reported with lower numbers. So I'm not out here saying that we're going to see a 2% handle on inflation, but you are going to see inflation continue to come down. So that's, no big surprises happening, at least as of now. Now, if you saw it go up, that would be a surprise, but you are likely to see inflation continue to moderate. And part of that is that rent shelter data that we've talked about several times here. But Josh, let's talk about this chart before we dive into loan level price adjustments.
All this is telling us is bank deposits. So if we look back, post-pandemic, with all of the stimulus, people had more money in the bank than anywhere. And it kind of goes back to Tina, there is no alternative. There was nowhere you could be invested in the stock market. You could be in your bank getting 0%, but those were really your only options. So we went from that to people spending their money or rapidly pulling it out of the bank, going into money market funds, other vehicles where you can get better returns with interest rates higher. That is a large part of what is putting the stress on banks. If we went back and read you the statement there from the Fed, they're basically saying, yes, there's some issues there, but it's well contained. We're going to be just fine. This is telling us those banks are going to have problems.
He's coughing.
Yeah, exactly. So it's telling us that they're going to have problems and there's further stress. The more the Fed ratchets up interest rates, the more problematic that gets. So while it wasn't necessarily inappropriate for the Fed to raise today, it's problematic for banks and community banks specifically, and we'll continue to see more of this likely where people pull their money out either because they want to go to another option or they want to go to one of the big banks that the U.S. government has determined is too big to fail.
Good stuff. So at the moment, a lot of questions still happening around Fannie, Freddie, FHFA, hiking, loan level price adjustments, lower credit score borrowers paying less, higher credit score borrowers paying more, the higher subsidizing the lower, all of that stuff. We did a podcast episode on it today. It'll be posted on next Tuesday. So if you want to see us, our faces, you can watch it on YouTube. If you just want to listen to our beautiful voices, you can listen to it on Spotify, Apple, all those good places out there. But we go into detail on it, all the information you need. Now, I know a lot of you guys have watched my video and seen all of that. But Josh, let's give some examples. So we look at this chart first. Let's look at this chart because this chart's important. So these, if you're looking at this chart online, if you're listening to the podcast, we'll put a link to it. But this is essentially a grid that shows you credit scores across the top, DTI across the top. Let's start again. Loan to value across the top, credit scores along the side. Anywhere where it's green, it's improved. Anywhere where it is red, has gotten worse. So Josh, throwing it to you.
So the thing that I want to point out here, this is not the actual new loan level price adjustments. This is a change from what we had before. So if you look here, anyone with a 679 or lower credit score, it's better. It doesn't mean that they're getting better terms than someone with a higher credit score. It means they're paying less of a premium than they were before. So in simple terms, anyone with a 679 or below is getting better. Now, if we look, Jeb, there, anything 70% loan to value or lower. So if you have more than 30% equity, you're putting 30% or more down. The only situation where it gets worse is a 680 to 699 credit score. The rest are all the same or better. So the last place where
makes absolutely no sense, by the way.
Well,
because if you have a 660 credit score, you actually get better pricing.
Yeah. So, I mean, what they're saying is they did a data analysis. We measured the risk, and this more appropriately reflects the risk in the market, which, again, we said this last week. I don't use this term lightly, but I do like this term. Bullshit. If you look at this doesn't make an ounce of sense. Across the board, anyone putting less than 5% down, so 3% down, no matter what your credit score, is cheaper than it was before. That makes no sense. That's the lowest down payment. 90 to 95, if you have a sub 679 or below score, is better. Every other credit score is worse. So really, who is looking at worse terms? So 2 points to make here. We made this in the podcast, so go listen to that. But the most important part is anyone with a credit score from 680 to 779 and putting 5 to 25% down is looking at worse terms than what they had previously, while everyone else got improvements. So is it fair? Is it right? No, it's not. Does it in any way reflect what they say it does, that we're just pricing risk? We're trying to build up capital to meet our reserve requirements? No, it's all a lie. And we won't even get into the fact that the government bailed out Fannie and Freddie to the tune of 187 billion. In 2019 had got back 310 billion, and we're raking all of that off the top, didn't let them recapitalize, and is now saying, hey, we need to change loan level price adjustments so they can recapitalize. How about you give us back the money that you stole for other purposes, Mr. and Mrs. Politicians? But that was a piece, Jeb. And then the other chart, I just wanted to, I think this is important here to show you guys. There's two main things. Again, they're not telling us the truth, but I wanted to point out here, you can see the ones in pink there. If you notice, 3% down is a lower rate than 5% down. We're being told by the government we're pricing risk. No, you're not. A 3% down loan, whether it's to the 740 borrower at the top or the 660 credit score borrower at the bottom, 3% down is more risky than 5%. There's no world in which it should be priced better. They're trying to make excuses and claims around mortgage insurance. Well, cool. They both have mortgage insurance. And yes, the mortgage insurance is cheaper on 5%, but you have the same coverage. There's no reason that one is cheaper than the other. But I also wanted to make the point here, Jeb, you look at the top of 740, it's a 6 3/8 rate for 3% today. It's a 6.99% rate for 660. So although the 660 credit score had less LLPAs than they had before, they're still paying a significantly worse interest rate. So don't believe into the lies that, hey, I should get my credit score down to 660 so I can get better terms. They're getting more improvement. You keep going away from the data there, Jeb. We were going to show them the FHA numbers as well.
I thought we did we not?
No, we're just talking about the 3 and 5% down. So the big thing that this is going to do, whether you're a 740 borrower or a 660, both of those people are going to get pushed over to FHA, because for the 740 borrower, it's a $300 savings to go FHA. For the 660 credit score, it's a $1,000 a month savings. So basically anyone with a sub 700 credit score and a minimum down, whether that's 3, 5, whatever it is, they're going to go FHA. So we didn't help. We're not recapitalizing Fannie and Freddie because none of those loans are going to come in the door. We're not subsidizing anyone because those loans are not coming in the door. They're going over to FHA, and it is what it is.
Josh is he's perturbed by this whole thing. He spent all
Triggered.
day perturbed. He's just spent hours just beating his head against the wall because he hit, like Sandra, whatever her name is. He's got her picture on the wall and he drew like a circle around it and he just throws things at it all day just to let off the steam. So that's where Josh is at. So guys, how are you doing? That's really what I want to know. Let us know in the comments how you're doing tonight. We know Willing is doing well. She's here. I think it's a he. It's a he. Is here giving us,
I believe she
praises.
said she's leaving.
But anyhow, we are going to answer some questions here in just a moment. Some easy ones to just kind of knock out pretty well, I don't know if they're easy, Josh, because at the moment, nothing is easy because nothing is going up, doing what we think it should do in some regard. But Arnold says, did the 30-year fixed rate go up with the rate hike? So there's a misconception, Josh. When the Fed hikes the Fed funds rate, that automatically you're going to pay a higher mortgage rate. Is that true? Did that happen today?
No. So mortgage rates track expected inflation, the direction of inflation. The markets expect inflation to come down, and the Fed hiking yet again reinforced their belief that that will lead to recession, slowing economy, lower inflation numbers, lower interest rates. So we actually saw a very nice improvement. Much worse on Monday, got it all back yesterday on Tuesday, and then got a bunch more improvement today. So much, much better than where we were prior to the Fed meeting.
And then Rakesh is asking a similar question, but saying mortgage rates. Do you see a big move down next week after CPI data comes out on May 10th? So, Josh, do you think the numbers will exceed in a positive way what the market is expecting? And could you see a rally in rates immediately, or does it take time?
No, it would happen immediately. If you had a spectacular CPI number on a month-over-month basis, we know we're going to have a pretty big number falling off from last year, and we have the potential for a big downward number based off of the housing component of the services inflation catching up. So there is that possibility. But let's talk about that, Jeb. What would be just a spectacular move in the 10-year? We ended today. Let's take a look at that.
Well, it looks like
3.3.
Yeah, 3.3.
3.35.
Yep. It looks like the floor is 3.29.
Yeah. So breaking below that. So long way of saying on Monday, we hit the top of the range. We always say when you're range bound, which most of the time we are range bound, you don't have a breakout one way or the other. When rates hit the top of the range, you float. And then when they hit the bottom of the range, you lock. So from Monday, we hit the top. Here we are Wednesday at the bottom. If you had followed that advice, float at the top of the range, lock at the bottom, you would be in a good spot. So unless we break out of the bottom of the range, so we have two big pieces of data that could come. We got jobs, which the Fed looks closely at on Friday, and then Wednesday we've got CPI. One or both of those could push us out of the bottom of the range. So 329 being the bottom of the range, what would you consider a spectacular move, Jeb? Like a move down to 305 to me would be a huge, huge move. That's 25 basis points. If mortgages followed and rallied as strongly, what are we talking about? A 0.25% improvement in mortgage rates. So that's a big move in the market, but how big of a move is that for you, in your monthly payment?
And I think it's important to note, like, whatever happens with the Fed on Wednesday isn't going to send rates down to 3% or 4% or even 5%, right? That takes months and months of bad economic data, of positive inflation data to actually get rates to move like that. And I think, not reading into the question, but I think that's the question that most people want to know is, when do we see the big drop in rates? Well, I think 3 months from now, in theory, is when you could really start to see rates move big, really make moves, because you've got these 3 big inflation numbers coming off. And I think people want to see what happens when these big numbers come off, and then almost what happens the following month when we don't have a big number to replace. You just have, a smaller number. I don't have the chart in front of me showing what that was, but a smaller number to replace. In fact, I think July of last year was like 0, right? So is it 0 again, or is it 0.1? I mean, do we start to see inflation trail back up, or are we still seeing it come down? So we're months away from a low 5 handle. Best case, in my opinion. But again, Josh tracks this better than I do. I'm just along for the ride, guys. I got a 2.99, right?
You
I'm
don't
sitting.
care. You don't watch it.
I mean, I do care, but I don't care. I mean, I'm one of those sellers, like, I'm locked, baby. I'm not, can't do anything. So that's where I'm at.
So really a 25 to 30 basis point move, I'm just looking back over the last couple of years, it's taken about 30 days, 25, 30 days, calendar days. So 15, 20 trading days to see that kind of a move. So I wouldn't expect anything massive. We've now, it's, what is it? Bodies in motion, bodies rest in motion, all that stuff, physics. So we
Inertia.
are on inertia.
Bodies in motion tend to stay in motion.
We are on a trajectory. The market over the last 18 months has come to believe that inflation is high and is likely to remain high. One set of data is not going to convince them otherwise. 2, 3, 4 months of consecutive data, when we get 3.5, 3.2 on year over year CPI, then you'll see a fairly rapid reduction. But in the grand scheme of things, think about this. We have the Fed funds rate at 5.25 now, but the 10-year is at 3.35. So the 10-year is saying, hey, Fed, whatever in the world you're thinking is not going to happen in the long run. So the biggest improvement likely to come for mortgage rates is once the market thinks we've kind of stabilized in terms of interest rate. Once mortgage-backed security buyers believe it's stabilized, you'll see some normalization in that spread between mortgage rates and the 10-year, and that would be as much of a move as we're likely to see in the 10-year, because I don't think we're going to have a 2% 10-year for at least a year. So if we're saying we think rates are going down to 5, a lot of that is going to come from the normalization versus the normalization of the spread versus a decrease in the 10.
Good stuff. So we have a couple of different questions here that are fairly easy to answer. Minister Victor Simons says, are video tours with buyer contract worth it? I'm in Augusta, Georgia. So I'm assuming you have a buyer's agent and they're just doing video tours. That's what I'm getting from that question, Josh. Does that make sense?
Yeah.
I mean, a video tour is great, but nothing like seeing the property in person, right? I mean, we've talked about this a couple of times. Video tours are a great place to start. If you're out of the area, get a feel for the property, or maybe you know exactly what you want. Maybe you've been in the model and you're just looking to verify that the property is what you think it is online, and you've got an agent. That's better. If you're new to the process, new to the area, not familiar with the homes, the locations, all of that stuff, nothing like seeing it in person. So video tour is a good place to start. Put an offer in some cases. Once your offer gets accepted, I would make the time, effort, energy to go out and see the property in person to make sure it's everything that you think it is, so that you're not, a buyer with remorse when you end up closing on it. So
I've spoken on this one before, Jeb. I am way too picky to buy a house with a video tour.
Very true. Maverick says, too scared to sell my condo and won't be able to buy a house in California. Not really a question, but it's a comment, because I want to comment on it because it's true. If you are selling a property in this environment and you have the thought that you're just going to be able to sell and go out and find something immediately, you might be in a world of hurt, unless you're moving to an area that has more inventory. You've been watching the market, following it. You plan on renting for a period of time, whatever it is. Just there's a lack of it out there, right? The lack of opportunity for people to sell one, buy another, for it to happen concurrently. unless you're able to put something under contract without it, going to market or what have you. So it's a reasonable concern. If you're considering selling, I would do contingencies to make sure that you're able to keep your property in case something doesn't happen, or sell with the expectation that you might not find something and that you might be renting for some, period of time before finding the next home. All reasonable things and things that you have to consider in a market with low supply.
Jeb, we've got
Yep.
a super similar question here. Big G, who's here every week, says, I don't have a mortgage, but I don't want to sell, and I want to sell and move, but I don't want to become a buyer. Advice. So do you not want to become a buyer because you don't want to be out and competing in this market with other buyers, or you want to become a renter? Two very different questions. Like, if it's just avoiding the market, it is what it is. You're going to have to fight it out and put up the dukes if you want a house in this market. But Jeb, a question I had for you, that borrower I had in Colorado wanted to buy $1 million house, owned his home free and clear, VA borrower, so he could qualify without selling his home, and then he was going to sell his home and pay the new mortgage down. And he said, I have to do that. Can't go contingent out here in my price range.
Mm-hmm.
No one will accept an offer. Again, I know you can only speak on our market here, Orange County, Southern California specifically. Anyone having any luck with contingent offers in the current market?
I don't have any at the moment. I have a property listed at the moment that we received an offer in maybe 2 weeks ago, and it's a relocation sale. So it's a little bit different in not only does the seller be able to decide on the price or get to decide on the price, the relocation company has certain terms and things in there that they make it a little bit more difficult on the seller because of the benefits the seller gets from using the relocation company. So it's a little bit complicated, but we received a contingent offer. And in this case, the contingent buyer hadn't even listed their property yet. Okay. So they wanted to potentially sell their property, hadn't even listed it yet. In that case, the relocation company won't even consider it, right? It has to be a property that is on the market and in escrow to be considered, which would be my recommendation to any seller anyhow. Don't accept a contingent offer unless the other property's in escrow, or unless it's going into escrow immediately. So in this case, wasn't a viable offer for my sellers to consider. But in general, in the market in Orange County at the moment, you're going to have a difficult time. Now, if you're at a large price point, couple $1 million, $3, $4, $5 million, might be a little bit different. Just because there's less demand at those price points. You don't have some of the craziness and that you do in lower price points. So, again, we talk about real estate being local. Price points vary as well. So it's going to vary a little bit. But take, for example, Huntington Beach. As of yesterday, we had 4 homes in all of Huntington Beach that were single family detached homes. 4 under $1 million. But guess what? 3 of them, one was $1 million. 2 of them were $999,000. So if you took all of the homes in Huntington Beach that were less than $999,000, there was only 1, and it was priced low. So there's not a lot of inventory. So if you're a buyer in that market, so you're selling a condo and you're buying one of those, they're not going to consider a contingency because you've got way too much demand for the limited number of supply. And that's really what it comes down to in everything in this market, all negotiation really, is what is your leverage? Well, at the moment, contingent offers don't have a lot of leverage unless the seller, for whatever reason, doesn't have the motivation to do things quickly, or they like you, or whatever the reason is. Maybe your offer is so good that they're willing to wait for it because of that. That's where you're able to score, but not really happening. So a long way of getting to what you said, but I think it's important to understand some of the back end of this. It's not just, hey, contingencies aren't accepted. Why? Why aren't contingencies accepted? Well, that's why in some cases. Josh, we've talked about this one before. What percentage of monthly income do you recommend to stay below for your mortgage payment? So I'm going to say FHA will allow you, in many cases, to go up to a 57%. Conventional, 45 to 49%. VA, we've seen as high as 65, 70%. And so what would we see? What was George?
He was like a 71, and I have people in vetted VA.
He still owns his home, by the way. He's owned it for 3 or 4 years, so he still made the payments. Actually, maybe longer than that now. But what is your recommendation? What is a number? Do you recommend it? Do you give that advice?
Well, here, let's go to someone that does and use it as a baseline to start. I actually saw this pop up the other day. So Dave Ramsey, which again,
1%.
a lot of what Dave Ramsey says is great advice, and no one ever went broke following Dave Ramsey's advice, but you may have been prevented from getting rich following some of Dave Ramsey's advice. In this situation, he says 25% of your take home or net pay. That's wild. So 40% of your pay generally goes to taxes and withholdings. So let's say you make $100,000 a year. We just took that down to $60,000 and divide that by 12. We got $5,000. So if we go 50% or 25% of that, we got a $1,250 house payment. And don't forget, he recommends you do a 15-year mortgage with 20% down, Jeb. So you are basically never going to own a home because no one in any high-priced market is able to keep it at that level.
Nobody in any market can do that, Josh.
So
Where
I'm
can
just
you
saying,
get a mortgage payment for $1,250 that is a 15-year loan? Like, what price is that? It's got to be like a
less than a
$50,000
hundred
home.
thousand. Yes. So long way of saying, be careful whose advice you take because they don't use Excel spreadsheets to actually see what they're advising you to do. I saw another article this morning, Jeb. Young lady, she's 30 something, so she's super young to me. Living in New York City, makes a little over $200,000, and she's finally going to move out of Manhattan because they've raised her rent in the last 2 years $1,000, and she's now paying $5,500 a month in rent. So remember, guys, depending on where you are, everything is relative. So for her, $200,000, $17,000 a month, a third of her income is going to rent. I can tell you, it is pretty rare. I have a client right now that's probably like perfect world. This would be ideal if most of my clients could do this. Jeb, friends of yours that you referred over, they're buying in Sacramento. They're ending up like at a 30% debt to income, 25% on the house, so 25% of their gross, and they have minimal debt, so they're at like 29%. That's really comfortable. No one's going to have a problem. They're renting now. It's a little bit more than their rent, but they are still dialed in. So if you could keep your total debt to income under 33% of your gross, that would be ideal. I would start being very cautious above 40%. We do a lot above 40%. I just want to know, what are we not picking up in your qualifying income? I have a lot of clients who have qualifying income that we can't use. A bonus they've only received for 1 year. Overtime, commissions. Hey, I just got a promotion. Now I get commissions, but I've only got them for a couple months. Hey, my aunt lives with me. She's not going to be on the loan, but she's going to pay $1,500 a month towards the rent. So just know what your situation is. If you're going above 40%, a lot of people do it, and they do it successfully. In a perfect world, you're going to be below that.
Good stuff. A couple of good questions here. Let's see. Jay Homeboy says, is it common for brokers to ask for letters of loan cancellation if you started the process with another lender or broker? Josh, do you ask for cancellation letters?
No, we just send them mean messages and ask why they wouldn't want to use us.
No, but
No,
if Jay Homeboy comes to you and said he was working with another lender, do you ask him to show you something that he canceled with his other lender?
no, and I think what they're actually saying is that if you started the process, I think you're reading it right, and I was thinking the other way. So we are required to to adverse the file at a certain point. So basically, this loan did not move forward. We have to report it to the CFPB and the NMLS call report. And basically, we have to say this person was pre-approved, chose not to move forward. This person was approved, didn't accept our terms, whatever that is. So I was reading it as they were just wanting confirmation in writing from you that you didn't accept their terms. But no, I don't care. You could have talked to 50 different lenders. I got an application this morning. The woman, she's a shopper. She's smart. She's a consultant. She knows how to do it. She got on the phone, talked to like 5 different people, and I don't care. It doesn't matter that you started the process or got pre-approved by someone else. It matters that you are going to move forward with us. What you will have in your loan docs is a notice of intent to proceed. So basically, before you can be charged any fees, you do have to sign an affirmation that says, hey, I am moving forward with my loan with Josh, or we can't charge you any fees without that in writing.
There you go. Rakesh has another question. Says, does it make sense to go with a 7-year ARM over a 30-year fixed if the rate difference is 0.5% for a jumbo loan and refi when rates go down when inflation is under control? So the way I read this is the 7-year ARM is 0.5% lower than the 30-year fixed. Does it make sense in this environment to consider that? That's a sizable difference, especially on a jumbo loan.
I would do it 8 days a week and twice on Sundays. But the answer that I will give is almost the same advice that I give when we're talking about, do we lock or do we float? Say, when you hit the ground in Vegas, are you just dying to get to the craps table, or are you dying to get to the buffet or the shopping? There's two different types of people. And if you're the one that says, I don't gamble, I'm just not comfortable with that, maybe the 30-year fix is right for you. But 7 years is a long time. They have caps on those. So it's going to be 8.5, 9 years before you ever were in a situation where you would be paying significantly more than what the 30-year fixed would be right now. We know for a fact that rates are going to be lower at some point in the next 2 to 3 years. Is it 0.5% lower or is it 2% lower? That's the only question. So if your preference is a 30-year fixed, take the 7, save the money, do not pay any points for that, and then look at moving into a 30-year fixed as rates improve.
Josh, he didn't tell you where he stood on that, but he's the guy dying to go to the buffet.
Buffet.
This guy loves the buffet.
Golden Corral. I don't even go to Vegas. I just hang out at Golden Corral. Yes.
Sirloin tips from where I grew up in North Carolina.
That was the good restaurant in town?
It was the good restaurant in town. And if I was lucky enough, we might eat there once every couple of months, and I could do the sirloin tips. I don't remember if it was unlimited buffet, but I could get those, and that was like a special treat, Josh. So just bring me back. Let's see. Demetro says, I'm waiting for my model home to be ready. No closing date yet, approximately July, August. I can lock the rate now at 5.8%, 6.1 for 5.1 to 6,
yeah.
5.8 to 6.1 for 180-day lock or 90 days free. So the 180 will cost them some money. Does it make sense to lock or to be floating down? So understand, Demetro, this isn't advice, but it's a good question. So let's hear the answer.
So
you're not advice.
We just talked a little bit about that lock float. So are you super conservative? Do you not like gambling in any way, shape, or form? Then take that question off the table. If you're comfortable with today's payment at those rates and you don't like uncertainty, then go ahead and lock it. Now, that being said, Jeb, we have been way below the 200-day moving average on mortgage-backed securities and the 10-year for quite some time. And that tells us that the long-term trend is for worse rates. Well, about 3 weeks ago, we broke above the 200-day moving average for about a day and got pushed back. About 10 days ago, we broke above it for like 3 days, got pushed back. Today, we broke above it again. We broke above it solidly throughout the day and then ended up just above it. And I think that's because we have that jobs report Friday. We've got CPI next week. So if you're comfortable with it and you can watch that and see that we're above the 200-day moving average, I would like to see how the jobs report and CPI play out. So I would have my finger hovering on the button that if there was a blockbuster jobs report, maybe I don't want to see CPI. If there's a neutral sort of middle of the road jobs report and we get to CPI and CPI is a terrible number and it shows inflation out of control, have your finger on the button. But I would want to see those two before I lock in the current market.
And here's my answer. My answer is go to the builder's lender and lock that thing for 90 days. Whatever your time frame is, so you don't have to pay any money. And then if you get closer, rates are down, go find yourself a broker. Get yourself a better rate. Hey. Now lenders hate that, but the reality is it's probably the right answer in this environment.
Jeb, I talked to a listener of the show. We've talked about this before on the show. 2 years ago, you said, hey, you're talking to the builder's lender. I said, cool, have fun, talk to them, come to me when you want to get actual good terms. And I don't care what the incentive is because it's smoke and mirrors. Well, over the last year, 9 times out of 10, it's not. It's actual, real good numbers. So find out what the incentive is. Talk to a buyer, a viewer of the show here this morning. I said, just send me the numbers. I can confirm real quick. Are those real numbers and therefore a real incentive, or are they inflated numbers so the incentive just gets you back to where you should be? He had a $15,000 credit. So in this instance, if you say, hey, I'm going to lock, and that $15,000, we get 3-4 points improvement in the market, then poof, your $15,000 disappeared. So I don't disagree with you. It's not bad advice, Jeb. I would just want to know what that incentive is and if it's good. So get your broker lined up now and deal with the builder's lender and have your broker look at it. Like I said, I don't care. I'm not going to try and talk you out of an awesome incentive from the builder's lender. I'm going to tell you, help you and advise you to close the best deal with the builder's incentive, because in 6 or 8 or 10 or 12 months, you're never going back to the builder's lender for a refi, and rates are going to be lower, and you're going to remember the nice guy who helped you maximize your builder credit, right?
Right. All right. Alberto has a question. Says, thanks for all the hard work you put on this. We appreciate you. Appreciate the support. But his question is there any data related to how layoffs in the tech industry have affected house prices in areas with many tech workers like San Francisco or Seattle? So I'm not sure if we have any specific data on that. It's obviously tech workers are a part of it. But here's what I'll say. The politics in San Francisco is part of the problem. That mayor's lost his damn mind. It just like, it's crazy. Now, I don't know. I can't speak to Seattle, but areas like Portland, I mean, you're having similar issues there. So that's part of the reason that you're also having people want to get the heck out of there and not buy homes there. Only part of the problem. The other problem is home prices appreciated a lot over a very short period of time, which just, it's unsustainable for that to continue. Therefore, you're seeing a pullback in prices. But Josh, data on layoffs related to a specific market. Yeah, there's definitely layoffs in that market. I don't know how much of that is from that and how much of that is from other things.
I think the bigger change for tech workers is not solely that that they're having layoffs. Those that are keeping their jobs, a big portion of their pay was this incentive-based stock options where, hey, stock's going through the roof. Well, the interest rates going up made financing for those companies much harder and made those crazy levels of growth where you could lose money for year after year after year and the stock is going through the roof. So I think a lot of those people are just not seeing the incomes that they expected or were hoping for or had previously seen. So they're being more cautious. You're 100% correct about the politics of those areas. You may be 100% on board with their politics. That doesn't mean you want to live in the middle of that. You saw Nordstrom shut down both, or is planning to shut down both of their stores in San Francisco. The geniuses in Oregon are passing a law, or have proposed a law and trying to pass it, that it is not illegal for an unhoused person, because you can't call them homeless, although they are by definition homeless. An unhoused person has rights in any public property. So meaning a park, a government building, they can do whatever they want, post up anywhere there. Never mind that will draw more homeless people from the rest of the country who don't have these favorable laws. And the crazy thing is, Portland is an amazing city. I should say was an amazing city. Jeb, you probably never spent any time in Portland back in the 90s before they lost their minds and went crazy. It's a little weird, a little kooky. It's always been liberal, hippie. It was an awesome city. You would have loved it. San Francisco was an awesome city. Seattle, an amazing city. I used to tell people Seattle's like San Francisco, only cleaner. And now they're all just going to hell, even though there's amazing things there. So it's like the wanting to help people and just not be, it's sort of like the undisciplined parent. You don't make your kid better by never making anyone follow any rules. And that's what those cities are experiencing. I understand the desire to give your kids everything they want, but when you let them eat, sugar for breakfast, you're going to have a bad afternoon.
Agreed. Yes, exactly. The show could take a turn here and we could just talk crap on all these places, which actually be more fun than repeating ourselves, for the rest of the show. But you guys are here for housing questions. So we're going to housing questions, not unhoused. Housing questions,
housed questions, not and Jeb, I almost, next time I go, we drive.
Never use that word in front of me ever again.
We drive.
I don't accept that. That is not in my vocabulary.
We drive to Washington once a year, and we have to go through Portland going up there, and I'm going to video it going through, because I don't think you folks, they don't show it on the news. You have no idea the insanity of what you see in Portland with what they allow homeless people to do. Like, it is absolutely crazy.
Agreed. Let's see here. Burn It Up says, have you noticed that many businesses are coming up to the high desert California, and the homes are getting expensive. Do you see more people moving up here because the 15 freeway is crazy? Not really. I think people, again, you have to take this with a grain of salt because I don't know specifically, but I think a lot of people are moving out that way because it's less expensive to live, right? The high desert homes are less expensive. Therefore, if you want to own a home at a more reasonable price, that's the direction you're moving. Now, I do know that there are businesses opening out there, right? I mean, just came back from the desert, Palm Springs area of the desert, and Amazon obviously building 2 huge facilities out there. They already have one. They're building another massive building. Skechers, I saw, Josh, they moved out to the desert area where, they have that big,
Was it Beaumont?
they have that big facility that's prior to
2
going
big
through
ones.
so I don't know if that one's going to close down. They're opening the next one or if it's 2 or what, but yeah, definitely more land to build, right? So businesses that need this industrial, this, million square feet of space, they need a place to put it, right? And there's land out there to do it. So, but at the end of the day, I think it's affordability that's driving more of that than anything else. Plus the 15 is crazy.
I would say maybe, Jeb, a little bit of work from home also. There's lots of people who don't want to leave Southern
Agreed.
California. They'd like to be within driving distance of beaches, mountains, LA, that type of stuff, but they don't want to fight that traffic every day. And if they can work from home, they can kind of get the best of both worlds.
No, absolutely. Absolutely. Let's see who. A Aguas corrected me. Says what? She's lost her mind. I think I said he when I said the mayor.
Well, it's hard to tell these days. We don't know what she identifies as.
Well, exactly.
We'll use her preferred pronouns. Whatever goes on under the hood, we don't know.
There you go. So we'll use that. It's she. I think I said he. Nevertheless, still crazy politics. Let's see. The Art of MD says, if a ton of affordable homes somehow hit the market, don't you think investors like BlackRock would buy them before the rest of us can? So I had a similar conversation with a buddy of mine who used to run a hedge fund in Charlotte today, asking him a similar question. And he seems to think the answer is no. He seems to think that the BlackRocks of the world are going to get hit a little bit harder because of a lot of the commercial space and stuff that they own, and therefore won't necessarily be in a position to buy this stuff. I don't know if that's true or not true. But I do know that there's less capital out there in the market because of where rates are. So the frenzy that you saw 2-3 years ago, I don't think that's going to duplicate. It's not going to repeat itself because money was so cheap then. Money is a lot more expensive. Even if rates come down, it's not going to be what it was. And all the incentives that were out there aren't going to be there. So will they buy some property? Potentially. Is it going to be like it was? I think the answer is absolutely not. And it might be partially the reason of the commercial stuff that they own and everything happening there, but more so the capital that, how cheap the money was I think is the big reason why.
Well, 2 pieces of it, Jeb. They were going after yield wherever they could find it. When you
Yep.
can borrow and you have that arbitrage, you borrow really cheap and you get that nice rent yield. Okay. But now we're in a world where, depending on what level of risk you're willing to take, 4, 5, 6% yields are fairly easy to obtain and you can be much more liquid. So we'll see. Their cost to borrow is more expensive. Their alternatives to get a yield while staying liquid are better. So all of that plays into it.
And they own several restaurants and have done a lot of building in the commercial space, like shopping center type stuff. And so we were talking today because they're looking at some commercial deals and trying to find opportunities out there in the market. And he was talking about, this building in San Francisco is a Class A, $300 million replacement cost to rebuild this thing. I think they said it was listed at like $30 million and not one person was interested in it, just because of the cost to rehab it, to make it, not more functional, but more of what people are looking for today. Plus, there's just so much out there, and a lot like we've talked, Josh. The commercial shoe being the next one to drop. He firmly believes that that's the case because of the short-term adjustable rates, the vacancies in these buildings, them being able to, go to the local community banks to get the loans that these banks are no longer lending because of credit tightening. So that'll be an interesting dynamic in the market. How it affects housing, I don't really see a correlation, but it's, it's definitely something to pay attention to. Anything there? No?
No, I just go back to this. They weren't asking what a solution is. There should be disincentives to institutional buying of single family residences. If they want to go out and buy up every apartment in the United States so we don't have mom and pop apartment owners, fine, that's one thing. But when we have a lack of supply of single family residences and we're allowing institutions who have access to cheaper priced capital than actual mom and pop everyday buyers, it's just silly. It's silly that we've allowed it. Other countries have put and I'm the guy, you've heard me say 1,000 times, keep the government out of it. Government regulations don't help. There's a sensible regulation that you could put in place that would allow some investment without squeezing out the actual occupant owners.
All right, there you go. $1 billion ideas. Thank you for the super chat. Says, I saved up $100,000 to move to Dallas. There are 1-bedroom, 1-bath condos for $90,000. Should I buy in cash? Will I get a better deal that way? Josh and I don't work the Dallas market. I don't know Dallas well enough to be able to tell you whether or not you'll get a better deal. Sometimes cash can get you a better deal if there is, ton of supply on the market. You're able to go in with cash and, offer a quick close and, better terms, then yeah. But at the end of the day, I tell clients all the time, whether you're getting a loan or it's the same amount of money in your pocket at the end of the day. So unless you have to do something quickly, the cash offer isn't necessarily the best offer, right? Yeah, it doesn't need an appraisal. Yeah, it doesn't need a loan. But if you find a good lender and you've done your homework, then those things aren't really a concern. Now, what I will say is the part of your comment that I don't like is the 1-bedroom, 1-bath thing. Now, to each his own. If that's where you see yourself, 1-bedroom, 1-bath, great. In my experience, 1-bedroom, 1-bath properties are harder to sell. There's just less people looking for that type of property. Therefore, they don't appreciate as much. They don't sell as fast in many ways. But again, if that's what's common to your, to that market, if that's what everything is, and a lot of people buy them, then I'm clearly wrong. Here in Southern California, those aren't, the bread and butter. That's not what the majority of people are looking at. Now, if you're considering starting a family, getting married, having kids, doing that, and you plan on selling that property in the future, then that's something to consider. If you plan on being single forever, don't want to live with anyone, great, have at it, buy that property. But just understand, what you're buying is going to be a little bit more difficult to unload at some point in the future. So my thoughts.
Jeb, again, I'm dating myself. A guy named Ward Hannigan down in San Diego is actually a lot older than me, but a super sharp guy, real estate investor, attorney, and he built his whole portfolio around what he calls dingbat rentals. So 1-bedroom, 1-bath, 2-bedroom, 1-bath houses, because they're less desirable. You can buy them more cheaply. They work well for rentals. They don't work as well when you have when you're coming time to sell. So they don't appreciate as well. They're harder to sell because most people, it doesn't work for their lifestyle.
No, it's good. I mean, I like the idea of, hey, you buy that, you keep it, you turn it into a rental. It's great. But just make sure whatever the rents are, it's probably going to have an HOA, right? Condo. I picture a high-rise building, high-density type thing. Typically have higher HOAs. Usually a lot of rentals in those types of buildings because there's a lot of units like that. So just understand all of that when making that decision, whether or not it makes sense for you, and what's the return, right? What's your cap rate? How much money are you bringing in versus how much, your mortgage is every month? Well, you're going to buy, if you buy it cash, then great. But I guess let's get back to the actual question, Josh. If he has 100,000 and he's buying a property that's 90,000, should he pay cash or should he finance that?
So over the long haul, the appropriate use of leverage is going to make you more money. Let's say that not even a great rate of return, but in the next 15 years, that thing goes up 3% a year. So 50, 60% higher. So if you pay all cash for it, you are going to go from 90,000 to 160 or so on the value. You made $60,000, $70,000. If you put 30% down, so you get really good terms, and you get a $60,000 loan. Well, that $30,000 down payment is now 125, 135,000 of equity. So your actual return will be much better. You'll be more liquid. You'll have some reserves. You can make other investments. So long way of saying, from my answer, you can probably tell I would not tie up that much money. What I would do would be to put enough down so that you are comfortable with where the monthly payment is. It's easy, not worrisome, and stay liquid and find some other investments.
There you go. Good stuff.
Ethereum. Buy
Excuse me.
Ethereum with
Yeah,
the rest.
yeah. Josh just wants it to go back up above the price he
Buy
paid for it.
Ethereum with the rest. It will go well above the price I paid for it.
Well, where are you at right now on that deal? I haven't looked at it. Are you
It's
positive or
down.
negative?
No, it's down, but
Oh,
it's going
okay.
back
I don't
up.
remember what you
worry.
paid and where it is.
We were in the high twos, and it was low twos. I don't look very often. It was low twos the other day, but
There you
Ethereum, don't go with this crazy Dogecoin and all that stuff. Ethereum will make money over the long haul. I will hang that out there. We can come back once a year and do the Ethereum update.
I think
Jeb.
we
I will
should.
make good money on my Ethereum.
All right.
investment.
I think it's good. I'm gonna mark this May 3rd. We're coming back 2024. And we're going to talk about where Josh is with that.
I like
Ethereum.
it. I like it.
So David says, with the recent banking troubles, how could a pullback in lending affect the housing market in the near term? So banking, smaller banks, right, is who's mostly affected by the credit tightening more so than anything else, right? Your small community banks. Does that affect lending? In some markets, the answer is yeah, maybe, right? If you are like from where I'm from, right? Small town, Kinston, North Carolina, you have several community banks, small community banks. If that's where you've done your banking your entire life, you might be going into that bank trying to get a loan and they're telling you, we can't do it. We don't, we're not doing that for whatever reason. Now, also in that town, we have First Citizens and we have some other, well, I guess First Citizens is a smaller bank too, but
you're trying to trigger me again,
we have
Jeff.
Bank of America
don't say that.
and what used to be Wachovia, which is what Chase now and that sort of thing. So you have bigger banks there. So there's lending available. But the smaller community banks, the tightening is affecting more of the commercial space. It's affecting these portfolio loans that used to be out there, where if you didn't fit into the Fannie Freddie, FHA, VA, USDA box, you could always find, maybe another opportunity, assuming you had down payment, credit, all of that's the stuff that gets hit. The Q, non-Q, what the hell's a non-QM?
But even the
Jesus,
non-QM stuff, it's not really done. It's not really done by banks. It comes down to mortgage-backed securities, different types of mortgage-backed securities. So it comes down to just realize that 95% plus of all residential financing in the United States is FHA, VA, USDA, Fannie, Freddie. That doesn't stay on the banks of books. Not an issue in any way, shape, or form. What do those community banks that are struggling really hard right now, what do they lend on? They lend on small commercial, big apartment buildings. Not who do they loan to? What do they lend on? So the things that we talked about, commercial, strip malls, office buildings, those things are going to struggle when those banks struggle. They are having capital problems. They are not eager to lend right now. And a lot of the loans on those types of properties are rolling over. So I think it doesn't follow that it would transfer or translate into residential financing, just because that's not the type of loans that are done in the United States for the most part. We've absolutely seen some changes and differences in the jumbo market, some of the credit unions that were doing stuff. So, and that is related to their cost of funds and what they can make money on, and being hard for them to make money on portfolio loans right now. But it doesn't in a big way impact the housing market.
There you go. Yo's Chopper says new home versus resale in this crazy market in Southern California. New homes are great if you can find one, and it's reasonably priced and doesn't have Melrose and all the craziness that goes along with it. That makes the cost, exorbitant when it, compared to a resale. I think I like resales, just because, typically in better locations, all of the things that we've talked about in previous videos. New construction is great because it's new, but with that comes added cost and everything else. And I think unless you're willing to move out to some of these areas where there's new construction, Now, there's certain developments, infill developments in almost every city, small little construction projects. They're great if they make sense for you. But a lot of them are tri-level properties packed in, not a lot of room for parking, not, just, I don't know, not ideal to me, but that doesn't mean it's wrong. So you got to figure out what's important to you in a property, location, all of those things. And ultimately, does the price make sense? And that's where you make your decision. But a lot of people think, hey, I've heard that there's 700,000 new construction homes being built. There's oversupply. Builders are giving deals. They're selling properties at a discount. They're offering all of this stuff. I want a new construction. And in all reality, yeah, some of that is happening, but it's not like it was in Q4 of last year, right? The market has changed. Therefore, it's changed for builders as well. So there's less of that actually happening. So just know what you're getting into and see if it makes sense. But I don't know that there's a right or wrong answer. It really just comes down to what you want in a property.
So Jeb, before we move on to our next
Yep.
question, this is something that you and I have talked about here recently in the last week, that we do a poor job of explaining to everyone watching how we are able to help them, besides just showing up here every week and answering questions. Do you want to maybe list the countless ways that Jeb and Josh can help those that are watching?
Wow. If you're having marital issues or
we're really good at that. We are really good at that.
Erectile dysfunction,
Not
talk
good
to
at
Josh.
that. Not helpful.
Anything else, I'm here. Now, if you're looking for a lender, you're looking for a real estate agent anywhere in the country, that includes Josh and myself. So Josh does loans in California, Nevada, Oregon, Arizona, Washington, Texas, some other places, Montana, like some of these crazy places where most of you guys probably, not crazy in bad way, just, they're not people where we don't normally see people from there. You can reach out to Josh. He can help you. There's a referral link that I'll put on the screen right now where you can go get connected with Josh or a lender wherever you're located. If you are buying a home in Southern California, in Orange County, I can help you. My team can help you. If you're buying a home outside of that area, I can refer you through that same link to someone who can guide you through that process, take great care of you. A lot of you guys have reached out. A lot of you guys have been connected and having great success and really happy about the process. So we're there for you that way. In addition to that, we have the Educated Homebuyer podcast that you can go check out on YouTube. It's videos that are separate from this channel, deep dive into a specific topic. Like I said, last week we covered value add to property, I believe we did. Was that last week or was that the week before? Today we recorded LLPAs. We've talked about down payments. We've talked about DTI. We've talked about everything in like a 30-minute episode that you can put on 2-speed, be done in no time, and become an expert. So check that out. Go subscribe to the channel. Lastly, here we can help you here. So, hit the thumbs up, subscribe to the channel if you haven't done so already. I know there's 200 of you listening at the moment or watching. And there's only 66 of you, that have done so far. But this helps the YouTube algorithm, helps push it out to more people. And ultimately, the more people that watch it, the more people that thumbs up, the more people that subscribe, the further reach it has. And that's why we do this every week. Josh, what did I miss? I got courses.
I've heard a rumor, Jeb, that you actually have a course that creates educated homebuyers.
Yeah. So the first time homebuyer course, it's in the description. You can check it out of the video. Kind of an A to Z on buying. It's 50 plus videos. Videos are no longer, from 2 minutes to probably 5-7 minutes at the longest, just kind of taking you through each step of the process. Mortgage lending, home buying, writing offers, getting offers accepted, all just, A to Z really. So if you're inclined, go check that out. And that's really it, I think. Yeah. Am I missing anything? I think
no,
good.
That's about it.
Yeah.
And with the podcast channel, Jeb is working hard here to get to 100,000 subscribers. What are you at now? 81, 82,000?
82 something, I think.
82 and change. Over at the podcast channel, we're trying to just get to 1,000, a measly little 1,000. So any of you who are not subscribed, head over there. Again, it's good content, good info, and we do like 1,000 shorts a week there. So if you have a short attention span and you want like 22-second videos, we got you covered.
We definitely have you covered there. And if you're in Huntington Beach, local to Huntington Beach, you want specific area information on Huntington Beach, there might be a channel out there, guys, for you. Can't verify or not, but check it out. if you're inclined. All right, here we go. We got a couple of questions here. A couple things have come in. So anyway, I want to thank you guys for the support. It really means a lot. And that's why we continue to do what we've been doing for a couple years now, still doing that. So David says, Realtor from Nashville, been in the business for 3 years. How can I grow my business profile? I'm in for the long run, not just to make money. Focus on relationships. Focus on building relationships with your real estate agent. Focus on your sphere, the people that know you, like you, trust you. Make sure they know what you do. I'm not even great at this, man. I've been doing this for 20 years. Most people know what I do. I do focus on the large majority of my business is relationship based. But if you're starting out, don't, focus. Open houses are great, all of that stuff to build business, but put those people in a database, follow up with them, provide value to them, let them know how you can help them. And then when you do a good job for them, ask them for more people that would like the same experience that you provided them. And that's how you build a business long-term. Any business, not just real estate, any business is built on relationships. Any successful business is built on relationships, so that when they think of real estate, they think of David. That's ultimately what you're trying to do. Don't get caught up in all the, shiny object syndrome of different things. Yeah, you can start a YouTube channel. Yeah, you can do all of that. But I would say any of that stuff, do it once you have the experience, the expertise, so that it comes across in the video or whatever you're talking about. I know there's a lot of information out there at the moment circling the interwebs where you can become, overnight success and no, it takes time. And none of it is a solo trip, right? The solopreneur. No, you need people. You need people to help you get along, to get to that step. So don't be afraid to ask people for help, right? Josh?
Along the lines of where you started, of just your sphere, who do you know? Focus on what you can give. Like, it sounds crazy, but rather than saying, hey, I want business, if you focus on I want business, it's going to smell like you want business. If you say,
Yep.
hey, I'm awesome at this and I can give that with no expectation in return. Now, again, Jeb and I just went through, it was kind of tongue in cheek, 2 minutes of how we can help you, because neither one of us do a great job of closing with, hey, if this is something you're in need of, here's how we can help. But we're always giving in terms of time, effort, energy, knowledge. So whatever it is that you can give, any area of expertise, ability, just give to your network and make sure they know what you can do, and they will return to you when it is time for that. But don't go out asking for business. I just talked out of both sides of my mouth. Make sure you ask for the business, but don't go out there and ask for the business. Does that make sense, or did I talk crazy, Jeb?
There's a Zig Ziglar quote that I often think about. It says, you can have anything you want in life if you help enough people get what they want, right? So Josh is saying, give, give, give. Don't expect anything in return. And ultimately, positive things will happen from that giving. And that's really how you build advocates of your business that will refer you. So again, take that to any business. I don't care what you own. You do that, you'll be successful.
And
All right.
along those lines, Jeb,
Yep.
here, Shay just had a comment that we both have great connections in the industry. Your network is really important. Connect people, connect with people, and
Yeah.
connect those people to each other. A lot of times in our industry, in the mortgage side, on real estate, if you can get paid for a referral. Mortgage is considered, we're regulated under the Real Estate Settlement Procedures Act. You cannot get paid for a referral. So I'm regularly referring things out to friends of mine. And guess what? When they have someone that needs to borrow in California, I get a phone call. Hey, Joe and Susie need to buy. Can you help them? Yep, I can. So the expectation isn't, hey, I'm going to get it in return, but I'm always connecting those people. It's right for the person that is asking for my help to connect them with an expert and to have that network. So long way of saying, I would just say, connect with people, connect those people to each other is one of the best ways. And anyone watching, Jeb, will laugh because they'll be like, that guy's antisocial and not a people person. But still,
They might
it's
say
what,
that about both of us.
and it might say it about both of us, but that's what this job is connecting people with people that can help them, and hopefully people will connect you with people when they need your help.
Good stuff. Karen, can you recommend a good realtor in Riverside? Yes. There's a really good chance that someone on my team can help you depending on where you're looking in Riverside. So reach out. that little link at the bottom will get you to me. Information's also in the description of the video. So hopefully that helps you. Salitha had a comment earlier just saying, hey, Jeb, Josh, it's me, the Naka buyer. My struggle, I'm looking for a multifamily in Orange, San Bernardino, Riverside counties. The problem is the rents are low and no one wants to pay for tenant move out. So yeah, that is a problem. The other problem is a lot of the multifamily out there, it's hard for it to make sense. With lower down payment loans to start with, because interest rates being so high. Yeah, rents have improved in a lot of areas over the years, but it still doesn't justify some of the prices that these owners are asking for properties. I mean, I get it, but it would be hard for me as an investor to invest in that at the current prices. So, and then when you're dealing with NACA, it's even more of an issue. So I struggle. You struggle. I struggle with the thought that you're having to do that. So, if you have an opportunity to do something differently, that might be the right answer.
And I would also say, listen, we did the podcast episode a few weeks ago with Michael Zuber. He's in the Fresno market, lives in Silicon Valley, and invests in Fresno. You're here in Southern California, Bakersfield, Fresno, Visalia, Tulare. They're not that far away. Price is much lower. Rent's not equally as much lower. If you're looking at it as an owner occupant, it's going to change things. You would have to be able to live at some level of distance. Even Bakersfield's a couple hours from most of Southern California, but there are areas with much better numbers. I would rather go to a lower priced, less desirable area that has better schools, safer, all of that fun stuff, than go to a marginal neighborhood chasing yield, because generally what you're seeing is any of the things that kind of look good on paper, multifamily wise in Southern California, are generally in less desirable areas where you're going to have headaches, maintenance, upkeep, tenant turnover, all sorts of fun stuff. And I say that I have a 4-unit building in Long Beach. It's a blue collar area, and it does very well. They're hard workers. We charge a fair rent. We keep the building in nice shape, and we've had zero problems. So it's not to say that there's never a reason to be in more affordable neighborhoods, but it can be problematic for you, especially as a first-time landlord and owner.
Good stuff. Fana, this was her first time here, and she's a realtor and investor, and she learned a lot. So, Fana, thanks for being here. It's always nice to see other industry, not executives, under industry professionals out here listening and watching. So, that's always good. Let's see, Josh. We've answered a lot of this. Here's one we can answer. Question for home equity loan. Will it change the current rate? So if you get a home equity loan, does it affect your current rate that you have on your, first loan? Let me answer that. The answer is no. But let's talk about home equity lines of credit and how they're affected by the Fed funds rate.
A home equity line of credit is a variable interest rate. 99 times out of 100, not 100 out of 100, 99 times out of 100, it's tied to the prime rate. Prime rate directly moves with the Fed funds rate. So yes, they hiked a quarter today. Your rate is going to go up a quarter.
There you go. David
Daniel,
coming through. Well, go ahead.
Go with David.
No, go for it.
So,
it's already here on the screen.
Yeah. Well, now we're
Dude,
just jumping all over the place.
Live in Bakersfield, buying new construction. FYI, prices are not going down here.
What I was saying is the recommendation wasn't in terms of prices going down. It's that prices are much more manageable than Los Angeles. Still a nice area. A lot of people move out there. Big population growth. Rents are not as much lower relative to Los Angeles as prices are. So if you're looking at an investment property, the numbers make much more sense in the Bakersfield area. And again, if you're an investor, do you want to buy which almost anything in Los Angeles proper, Los Angeles, Orange County, falls under that bread and butter category. You're paying a premium, your rents are low relative to what it costs to own it. Or would you rather buy 2 hours away where those numbers make a heck of a lot more sense and your property is probably nicer?
There you go. Good stuff. Let's see. We'll get to David in a moment. Just join. So this is from AA. AA is calling you,
Man.
Josh. They finally found you. Should I get in on the FOMO? It seemed like prices will only go up if there's no inventory. Rent 1,900, mortgage 2,500. Would you jump? $316,000 house, 1,819 square foot. So, no, never jump because of FOMO. Is there a chance
The answer
prices?
is yes, but you are right. Never because of
Yes.
FOMO, but the other things you say in there are
Yeah,
absolutely the same. Yes.
inventory controls prices in many ways. So if there's a shortage of inventory, you're not going to see any big reduction in prices. With that said, FOMO is never the right answer to buy a house. You should buy a right house. You should buy a right house. Yes, you should. You should buy a house when it's the right time in your life, money in the bank, comfortable with the payment, all of those things, stable employment, like whatever it is for you, not because you fear that prices are going to go out and you're putting yourself in a position where you can barely make the payment, but you want to get it done so that no, that's not the right time. So to back it out, I think there's some questions you need to ask yourself. How long do you plan on living in the property? That's important, especially in the current environment, saying probably 7+ years now that you need to be in a property with the thought of being in that property, not because there's a crash coming, just because there's a chance that even though there's no inventory, you're not going to see huge appreciation because you're coming off, a couple of years of monstrous appreciation to start. So the likelihood of that continuing isn't high. And there is a chance that prices could go lower. There's always that chance. And you don't want to be in a position where you're upside down and you bought for the right reason, I bought for the wrong reasons and all of that. So that's the simple answer. Now, David, how do you know when it's time to switch brokerages? So coming from a real estate agent. So here's what I would say. Most brokerages, shiny object syndrome, right? They say, hey, we got this great technology. We have all of these programs that you can use, all this crap. It's garbage, all of it. All of it. I don't care what company. It's all garbage. You're not going to use 99% of it. Find a brokerage with good agents that do business and have an environment where you want to be around. That's really it. I mean, obviously commission splits and all of that thing are important. But all of the brokerages out there, offering commission splits. I mean, offering, a pay structure to bring people on, and we have the best technology. Yeah, it's all great. I'm being facetious. None of it means anything at least to me. To some people, it means a lot. But I would say focus on relationships and building your business and not get caught up in everything else. All right. Well, that was kind of me on a rant there, Josh. World Trekker says pros and cons on turning a primary to a rental, but would need a property manager. What should one look for in a property manager, Josh?
Why do you need a property manager? Why do you think a person would think they need a property manager?
Why? Because they don't know how to manage a property. They don't have the resources. They don't have the contacts to be able to do the stuff. They wouldn't know what to do. Maybe they're out of area. They don't have the ability to just zip over to the property and fix something or make a call or whatever it is.
What's a typical property management fee?
I would say typical is 10% for many. 10% of the monthly rent. So you bring in, $3,000 a month in rent, paying $300 to a property manager.
Unless I'm confused, World Trekker is here in Orange County, so it's probably $3,500, $4,500 a month of rent. There's no world in which I'm paying a property manager. It's not that hard. So I'll play devil's advocate. I'm going to tell you, and again, the curse of knowledge. I know what I know, but Zillow Rental Manager will allow you to email someone an application. If you have a pulse and a little bit of a brain and have been around, you can read through it. You can see who has a good work history, who has not moved around 1,000 times. It will allow you to charge them and pull their credit. So you can see their credit history. You can see if they've ever had an eviction. It does a criminal background on them. Use your gut instincts. Unless you are really bad at evaluating people, you're going to get 10, 15, 20 people through the house. You're going to look at the applications. 2 or 3 of them appear to be well qualified, and one of them is going to convince you that they're the right person to be in that house. So are there occasionally some headaches? Yes. But is it worth not paying $3,000 to $5,000 a year to a property manager? I say yes. So Jeb, man who represents other people by managing properties.
You
Tell
just
me
killed
why
my
I'm wrong.
property management business.
Tell me why I'm wrong. Why everyone needs a Jeb in their life.
Because I think you don't. You don't. Really simply put, you can do a lot of this stuff yourself. Like Josh said, you don't need me to manage property. But if you need me, reach out. I don't charge 10%. But here's the thing. Most people don't want to deal with it. They don't want to deal with people calling them. They don't want to deal with complaining. They don't want to deal with having to find the right tenant. Some people aren't capable of knowing what to look for. Just the reality, unfortunately. Josh, you're a smart guy. Not everyone understands real estate like you do. Not everyone has the wherewithal to, know how real estate works and what you should look for and all of that. So that's really what it comes down to. It's just a lack of experience in doing it. Josh doesn't have that, right? He has bought and sold several, many 10 times as many properties as most people ever will, and therefore has an intimate knowledge of it. Most people don't have that. So, and if you think you can, you probably can. If you think you can't, you probably can't. Real simple. All right. We are 6 hours and 27 minutes on, man. Nice. Just flying by, Josh. Just having fun. Just fun. Rakesh, maybe our most loyal viewer tonight with the most comments, I'm not sure, says, what factors, conditions determine whether a lender decides to transfer or service a loan? So let's give a little backstory here on what they're talking about. So sometimes when you get a loan, say Josh does your loan, it closes with a company, A being the name of the company. After you make a payment or two to a company, they transfer the loan to B company. Why would a lender transfer a loan after only owning it a short period of time?
Most lenders are not in the business of owning or servicing loans. So we talked earlier in the show why residential lending is not likely to be impacted by the troubles that small and mid-sized banks are having. It's because those loans are underwritten to the guidelines of FHA, VA, USDA, Fannie, Freddie, and they go into pools and they're sold. And they're most likely, even if the loan is not sold, sometimes the mortgage lender will hold the loan, but they will transfer servicing. Like Loan Care, I had 2 loans with 2 different lenders. Both of them were with Loan Care for the servicing. So really it comes down to, there are a handful of very large servicers in the country. They're going to most likely get a hold of your loan at one point or another. And one of those loans with Loan Care got sold to Chase like 6 months into it. Why one and not the other? I don't know. 2 different owners of the loan, but now one is owned and serviced by Chase. It just comes down to, what are mortgage servicing rights at any time? They fluctuate, they go up and they go down. When they're at a high level, if the investor, the holder of that pool of loans, wants cash, then they're going to sell that pool to liquidate and put some more money on their books. But for the most part, you are going to have an immediate sale or transfer within the first 1 to 3 months, if not immediately before the first payment, within that first 3 months. And then just market fluctuations will dictate if people are selling loans or transferring servicing.
All right. Kim says, Josh, is it true you can't have any remarks on a credit report dispute?
Used to be true. It's less true now. If you have a ton of disputes, for the most part, the credit scoring model will ignore a disputed account. So the automated underwriting systems in the past said, well, no, we can't have that. You have to remove the dispute, get a new score, and then our automated underwriting system can see it and properly assess the risk. Now, for the most part, we don't need to remove the disputes. I won't say it's a never, but it is unlikely. But if you come to me with like 10 disputes on your credit report, we may have an issue.
All right, there you go. G Stacks says, is making a large principal payment and recasting the loan to rent out the primary home and make $1,000 in cash flow a good idea to qualify for another home? Also, can you use the cash flow as income?
So is it a good idea? It comes down to alternatives. What are your other choices? So let's go to the second part, to qualify for another home. So it sounds like if you don't do that, you don't qualify. So the second part, can you use that cash flow as income? On some loan programs, yes. On others, no, if you don't have a landlord history. So talk to your lender, go through your scenario specifically, find out which loan programs. Some will only allow you to offset the monthly payment. Some will allow additional funds above and beyond the rent to be treated as income. So go through it with your lender. But is it a good idea? Well, what are my alternatives? I thought there was to make $1,000 in cash flow. For some reason, I thought it said something about $100,000. Well, if to do that, you have to put $100,000 into the property, what else could you do with that $100,000 besides buying Ethereum with Jeb and I? You can
Not me,
invest it
bro. I don't
in
have any of that crap.
Jeb's scared.
Go ahead. You were going to say something.
Just saying, you have other alternatives. So once you do that, once you make that large principal reduction and do the recast, you are now tied into that. You would have to refinance to get that money back out. And I'm assuming you're at a really good interest rate. That's why you want to pay it down and recast versus doing anything else. So from that perspective, just be careful. You're not getting that money back out. So you have other alternatives besides reducing your payment and having more net rental income. And there's also some downsides to doing it.
All right, I'm just clicking on this one because I like the name and the little icon that goes along with it. Dragging my baggage. And there's a dragon dragging baggage. Hey, just clever. World Trekker, do you think South OC coastal real estate will still keep appreciating better than San Diego? Need to know how long I should hold on to my property. To each his own. Some people like San Diego. Some people like South OC. It's a matter of preference. I don't know that one's going to, depends. Are you comparing San Clemente to Oceanside? Well, yeah, probably going to do better. Comparing San Clemente to La Jolla, probably not going to do as well. So depends on where you are, specifically in those, but I think both are great places to be. Personally, I'm not sure that helps you, but that's my thought.
Over the long haul, they should perform very similarly. They're super close. The prices are not all that different now. People that are willing to live in San Clemente are probably willing to live in San Marcos. They're just not all that different. So I don't think there's going to be an appreciable difference between the two.
I think San Marcos is different than San Clemente. You are inland about however many miles on one versus the other on San Marcos, but
so technically, if we wanted to say,
I don't want to live in either.
There are uppity people who will live in San Clemente and not in Oceanside. But we want to say San Clemente and Carlsbad. Well, Carlsbad probably a little more expensive than San Clemente. There are nuances and differences to the neighborhoods, and I don't know them all, Jeb, to share the exact appropriate city. I'm just telling you, if you're willing to live in South Orange County, you're probably willing to live in San Diego County and pay similar amounts.
There you go. Dragging my baggage says, when you guys were new agents, did either of you join a team or go at it alone? So I went at it alone. I think in the environment that you're in now, with the whole team thing out there, I think it's a great way to learn mortgage and real estate. Get under a group. And yes, you can learn it on your own, but you'll learn it a lot faster being around people doing it, having access to more, hearing more conversations. You'll absorb more. I think that is the way. If I were new to the business, that's what I would do.
And I would say for me, when I got into the business, it was a glorious accident. We've talked about this before. I was going to go overseas and play basketball, and I ruptured my patellar tendon, and my dad was tired of me laying on the couch. So he said, get a job. So the easy move was to get into the mortgage business. The easy move to get into the mortgage business is to go to a call center operation that is generating leads and handing them off to you. So I was in, it wasn't a team environment, but if someone else was generating the business and there were people around to help and mentor and talk to you. From there, I quickly decided that was not for me, and we went out to a self-gen business, but still within the context of a small local company, and the owners were trying to get away from originating loans, and we're happy to sort of teach and hand off business. So not really a team, but if you can find a structure where there's some support and maybe you're not making as much as you would on each deal if you were generating it yourself, you'll still learn more. The most important thing when you first get in your business is to get your hands in deals. It's not how much you make from the deal, it's to have deals to work on so you can see what goes into it and how they actually work.
Good stuff. Awash, do you agree with the new Biden law regarding mortgage fees? So it's not a law by Biden. We talked about this early in the episode. So go back and watch the first probably 10 minutes of tonight's episode. We go over in detail what it actually means. how it affects buyers out there. We did probably a couple minute deep dive into it. Also, we did a podcast episode today that'll be published next week on the YouTube channel with regard to the same thing. And also it'll be on the podcast next Tuesday if you just want to listen to it. So pay attention to that. That's where you'll find all the good stuff. House Hacker saying, is the federal government still giving out $8,000 grants for a home purchase? No, that was like 10 years ago.
Not since 2010, but
yeah, that was like Obama era, I believe, when that happened, or maybe it was. Yeah, I think that's when it was. That was a while ago. We're not there anymore, man. We're not there. All right, guys, 6:30. What should we do now, Josh? Should we,
8:05?
8:05. 8:05 sounds good.
It's almost Cinco de Mayo in 2 days.
It is almost Cinco de Mayo. He is correct. Josh speaks the truth. I mean, that's what you guys come here. He speaks the truth. We're going to answer a couple more questions, and then we're going to let you people out early tonight. You love being in a class, when it's like supposed to be a 2-hour thing. And the instructor says, hey, if you guys listen tonight, we're going to let you out a little bit earlier. And then it's like an hour 59. And they're like, all right, guys, you guys were good.
You can go.
And then they just continue talking for the entire 2 hours. And then you're actually in there longer than you're supposed to be. Well, that's not going to be the case tonight. We're going to let you go early. Let's see. What do we have?
Michael says the technical term is Cinco de Drinko.
All right. Well, Michael's in Texas. He knows what those Texans do. It's bigger in Texas, I hear. Cinco de Mayo is bigger in Texas. Because Texas is bigger. Is new construction required to give at least a 30-day notice of a closing date? Josh, do you know?
I do not know. I do not believe so, because I've had clients that seem to be caught off guard by when they were expected to close, or getting it pushed off. Maybe they do, because the bigger thing is, hey, we're supposed to close on June 30th. Well, wait, it's going to be July 15th. Wait, it's August 27th. So maybe they do. I do not know. Do you?
I don't know. I would imagine it's probably in that contract that you sign. It will tell you how much, but again, they want you to close on time. So they're going to make sure that they're reaching out in most cases to make sure that you are sticking to, your timelines, your lenders doing their job so that everybody's on the same page. So, but I would imagine there's some sort of, time frame conversation to let you know where you are. All right. Let's see. Awash says, what is your favorite margarita? Yes is the answer. Yes. Josh?
The correct answer to the question is the NorCal margarita, Jeb.
No, just margarita.
Yes. No, the NorCal margarita is the correct answer. Otherwise, it's too sweet and you end up with a terrible hangover.
Just no salt, just the margarita, the ice.
Oh, the salt is the best part. What are you talking about? What is
that's why you're always bloated,
This guy over here.
Your face is so bloated, bro. It's from the salt.
My face is just twice the size of yours, because we're just different sized.
No salt.
Kim comes
all right,
back
guys.
All of them is the correct answer. All of the right answer.
So here's the thing, guys. We are going to let you guys out early tonight. I want to say thank you for the support. Thanks for being here every week. If you're new to the show, we appreciate that. Referral link scrolling the bottom, get you in touch with the lender, real estate agent, anywhere in the country. So check that out. There's also a link in the description below getting you to a first-time home buyer course that will guide you through the home buying process. Josh can help you by reaching out to him in most of the Western United States. I can help you buy, sell real estate here in Orange County, California. If not, I can refer you to somebody. Lastly, the Educated Home Buyer Podcast. Check it out. Spotify, Apple, go over to the YouTube channel and check that out. Subscribe to that, like the videos, watch us there. We're going to be doing lives there soon enough, guys. We might be off this channel. This channel might be dead.
We may move the lives over.
I might be over this channel, moving everything that direction. So anyhow, we appreciate you. Josh, final words this evening.
the key one for me recently is now that we had the fake news about FHA 40-year loans, and then fake news about get as low a credit score as possible so you can get better rates. Just take all of your news with a grain of salt and check with a trusted expert in that realm. Specifically, those two are mortgage related, but whether it's real estate, autos, whatever it is, if you see something that looks crazy in a headline, talk to someone you know that's a trusted expert and get the real information.
All right. Until next time, adios.
And via con Dios.